Thank you, Rich, and good morning, everyone. I hope everybody had a safe and happy Thanksgiving. I'm going to go ahead and get started with talking to you about some of the recent tax law changes. As everybody knows, 2020 has been one crazy year. It's been a roller coaster with tax law changes, with funding, with different programs that have been put out there to try to help get through this pandemic. But what I want to do is I want to kind of back up a little bit. We're going to actually start with the Secure Act. The Secure Act was actually passed last December 20th of 2019. And what this was an attempt to try to get more people to start saving for retirement or encourage employers to expand some of their offerings to allow more participants to contribute and start saving as well. And everybody's referring to this as a Secure Act. It's actually the setting every community up for retirement enhancement. So most of the provisions in this tax act will be applicable starting January 1st of 2020. Probably one of the biggest and most notable ones that everybody has talked about was with regards to the required minimum distribution increase in the age. Previously, through December 31st of 2019, you had, once you reach 70 and a half, you were required to start taking minimum distributions from your retirement account by April of the following year. They've actually bumped that up to 72. So now once you hit age 72, it helps those who were turning 70 and a half in 2020, it helps them, but those who turn 70 and a half by December 31st of 2019, you're kind of stuck with the old rules with the 70 and a half. So, but in addition to that, they also are allowing participants to continue to contribute to their IRA accounts as long as they have earned income beyond age 70 and a half. So they really don't have a specific time cutoff anymore. As long as you're still working, I've had clients working into their 80s and 90s. They retire from their long-time career or profession or business, and they decide they want to do something. They'll pick up a part-time job. They'll go work at Home Depot. Some people go work at the grocery store just so they still have some personal interaction. As long as you're still making money and still having earned income, you can continue to contribute to an IRA account. The next thing that I wanted to talk about that really impacts a lot of people is this 10-year distribution rule. The 10-year distribution rule basically affects those plan participants who die after December 31st of 2019. And it kicks in for governmental plans starting 12/31/2021. So participants who died after 12/31/2021 that had a governmental plan, a 401(3)(b), a 457, those accounts will fall under this rule starting after 2021. But what the 10-year rule is it eliminated what's considered the stretch IRA. The stretch IRA basically allowed people to name younger generations, grandchildren, younger siblings, whatever, children, as their beneficiary to their IRA accounts. And then those individuals were allowed to stretch out the IRA and take those IRAs over their life expectancy. I know we have a client who the grandparents passed away, they put it down to their grandchildren, and the grandchildren were only in their 30s. So life expectancy of a 30-year-old is going to be considerably less than the life expectancy of a 70 or 80-year-old. So the required minimum distribution each year from that plan is really stretched out almost 50 years longer. So the amount required to be taken out is much smaller, and it can continue to grow over that period. The 5-year rule that existed previously still is in play. That is for any beneficiaries for retirement accounts that were not individuals. Those would be trusts, the estate itself, governmental plan, or not government, I'm sorry, charitable contributions, anybody other than individuals. This 10-year distribution rule, one of the unique things about it is they don't require it to be done annually with a specific amount. So if you had $1 million in the account and you had one beneficiary for the plan, they're not requiring you to take out $100,000 over the 10 years. You could take out $200,000 one year, you could take out $500,000 the next year, you could take out nothing in the third year. So you can do it in any any method you want, as long as all of the assets are withdrawn from that account within the 10 years from the date of death. A couple exceptions to this 10-year rule I have listed here are with regards to surviving spouses, minor children, disabled individuals, chronically ill individuals, and individuals that aren't more than 10 years younger. So if you have a younger sibling that you put in as your beneficiary for your account and they're within 10 years, they would not fall under this 10-year rule, and they can continue to use the life expectancy. One note with regards to minor children, the minor children, if they're 4, 5, 6 years old, you're good until they hit age of majority. Once they hit age of majority, then the 10-year rule kicks in. So you won't be able to continue to stretch it out too long, just up to the 10 years. Okay, another area where they are encouraging employers and employees to contribute to retirement accounts is for your long-time part-time employees. This could be your part-time help in a doctor's office, part-time help at a law firm, where the employee's working either 2 or 3 days a week, or they may be working that middle of the day while their children are at school. They might come in and do like 10 to 2, 10 to 3, but they've been with the same employer for a long time, and I say a long time, 3 years. But what they have done with this act is basically have allowed, excuse me, those longtime employees to participate in the 401k where previously they weren't allowed to. And the reason they weren't allowed to is because maybe they didn't hit the 1,000-hour service per year in order for it to count towards being eligible for a participant. Most times these plans have a minimum age of 21, and they have 1,000 hours of service per year for the 12-month period in order to be eligible to participate in the plans. So these long-time part-time employees, beginning after December 31st of 2020, the 1,000 hours doesn't apply. The minimum age of 21 still holds, but it doesn't apply to the collective bargaining plans. And as long as the individual, the employee, has 500 hours per year for 3 consecutive years. So that could be 10 hours a week, 12 hours a week. And they've been with the same person, and I'm saying consistently, so that you hit the 500 per year. As long as they do that, then they can start participating in this plan the first day after they hit both the service and the age, or 6 months after the service and age requirements are met. So again, this is for plans beginning after 12/31/2020. So you have a few years until you have to get this lined up to get these part-time employees included in the 401k. What they've also done is realize that this puts an additional burden on employers with regards to the non-discrimination. So they are providing relief to the employers to exclude them from the top heavy and computation. A couple other miscellaneous things that were thrown into this plan. One was that they actually expanded the definition of earned income. As I mentioned earlier, as long as you're working a part-time job, whatever. Some of these graduate and postdoctoral study students don't receive. It's hard for them to contribute to a plan. So the fellowships, the stipends, those types of plans types of earnings are now all being included as earned income, so that if these workers do want to start contributing to their to an IRA, they are eligible because they do have the earned income. They added a $5,000 per person withdrawal ability, so you can take out up to $5,000 from your retirement account penalty-free prior to age 59 and a half for birth or adoption expenses. So if you have a married filing joint couple and they both have a qualifying plan where they can withdraw this money, you can do up to $10,000. If only one person, a husband or wife, have an eligible plan, they can take the $5,000. But if both individuals, husband and wife, both have an eligible plan to withdraw the money, they can take it penalty-free. Another thing that they've done is expanded the 529 definitions. They're now allowing the apprenticeship programs to be qualified as eligible distributions. If you recall, a couple years ago with TCJA, I guess that was 2017, they expanded the 529s to allow distributions to be for K through 12, where previously it was really just post-secondary education. So they are continuing to allow account owners to use these 529 plans for additional areas. The other thing is they're now allowing you to take up to $10,000 in distributions out of these 529s to pay for qualified student loan repayments. And you can also do it for siblings as well. But one thing to note is if you are taking advantage of this 529 distribution up to the 10,000, the portion of the loan repayment that applies to the interest is not eligible for the deduction. So that's just something to keep in mind. Only the principal payments obviously can stay, but the interest payments, you're not going to get the benefit for the deduction on those. Another thing that they've done is the safe harbor plans. They've increased the contribution amount from 10% now up to, you can now do up to 15%. And again, that's starting for 2020. They are also allowing small employer pension plans a $250 per participant credit, and that does not include doesn't include the highly compensated, so generally the business owners. And you can do that for you can get up to $5,000 depending on the number of employees that you have, and that's credit is available for 3 years. In addition to that, you can not only take that credit, but you can also take, if you do the automatic enrollment plan, where the employees automatically enroll after the qualifications are met. And that would be $500 credit for 3 years. And like I said, that's in addition to the other small employer pension plan. Something else, I went too quickly, I apologize. Something else that they have done is for defined contribution plans that are usually controlled by a control group, all identical as far as the type of plan, the eligibility, all the requirements. They are allowing you to consolidate the filings. So instead of having 3 or 4 separate filings, you can consolidate them all into a single employer plan filing for $5,500. One thing that they did throw into the Secure Act, which was kind of more of a correction than anything, and this was with regards to the kiddie tax. The TCJA, which was the Taxpayer Cut Job Act in 2017, they changed the way that children were paid. And when I refer to kiddie tax applies to children under 19 who have unearned income, more than 50% of their income is unearned, or up to 23, and they're a student and a dependent of. What this kiddie tax does is with the TCJA, they now have started requiring the children to pay tax on the unearned income at the trust and estate rates, which is pretty steep. About $12,000, $13,000, you're in the highest tax bracket. So you'd be in the 36% tax bracket. And that really, they recognize that isn't really equitable. So they did allow the option to use the pre-TCJA for 18 and 19. You had to go back and do amended returns because obviously this law didn't pass till the end of 19. So I do know we did have a client who was advantageous for us to go back and file an amended return to go back to the pre-TCJA rules, which tax the unearned income at the parent's marginal rate, where you get benefit of those larger brackets as opposed to being stuck with the estate and trust rates. Now I'm going to jump forward and talk to you a little bit about some of the CARES Act and the provisions that went into play with the CARES Act, which was the Coronavirus Aid, Relief, and Economic Security Act of 2020. And this law was passed on March 27th, right at the peak of the whole coronavirus. So they made a lot of changes and they provided some relief to individuals, basically, to allow them to either utilize retirement accounts to pay for to pay for living expenses as long as they were affected by COVID. And what they allowed you to do was basically take a $100,000 early withdrawal, which meant you didn't have to be 70 or 59 and a half in order to take this out, but it had to be COVID related. So you basically either your family member had to be impacted by COVID. So the 10% penalty was waived. The $100,000 if you lost your job and you needed to pay for living expenses. If you get another job and you go back to working, you have 3 years to pay this money back, or you can subject it to the income over a 3-year period. You could do it all in 1 year. If you know you lost your job in 2020, and let's say you took the full $100,000, you took advantage of it all, and you want to include $80,000 in 2020, you can do that. And then the other $20,000, you could either do it $10,000 each year, or you could do $20,000 in 1 year, kind of maximizing the rates as to when it would be best to take advantage of the tax rates. There's no requirement to, oh, I apologize again. There's no recontribution requirement, but if you don't take it, at least by the end of the 3 years, you don't pay that money back. You will be including it in income. So there's a lot of planning opportunities here, depending on whether you need the money, you want to keep it out, whether you want to pay it back. So it's definitely something, an area where there's maneuverability. The required minimum distribution, which I had spoke about earlier, where it went up to age 72, those participants who were already taking out required minimum distributions, they had already reached the 70 and a half. They basically do not have to take a required minimum distribution for 2020. If you had already taken them funds out, they had provided relief and you had to return those funds earlier in the year. If you haven't taken your required minimum distribution out for 2020 and you normally take it out at the end of the year, you do not have to take it out in December if you don't need to. If you want to take it out to cover expenses, or if you need it, by all means take it out. But they did waive that requirement for 2020. In addition, the 5-year rule that I had spoke about earlier as well, where if the beneficiary for a plan was not an individual, whether it was a trust, estate, 2020 will be completely skipped. So if you were already in the middle of the 5-year rule, where a decedent died in 2018 and you were taking it out, 2020 will not count. So you actually will have 6 years to do that 5-year rule. Now for the big topic for the CARES Act. I don't know how anybody could have not heard about this. They had to have been sleeping. This economic improvement payment. The other terminology that's being used is a recovery rebate. I'll get into that in just a moment. Both terminologies are for the exact same thing. But the economic improvement payment, that came about with this tax law change in March of 2020. And basically this was trying to get money back to individuals, whether they were out of jobs, they needed to pay rent, they lost, whatever their circumstances were. I'll get into the amounts here in just a minute, but basically these were payments being paid, provided to individuals via check, direct deposit, debit cards, and it was based off of your 18 or 19 returns, depending on what had been filed up to that point. So because obviously we were in the middle of filing season, which actually got extended to July automatically, if you had not filed your 19 return, they were looking to your 18 for the income independent to determine the payment that they were going to make to you. Individuals who didn't have a filing requirement, they don't hit the normal income thresholds, because most of their income is minimal pension distributions or IRA distributions with Social Security, where they're not exceeding the standard deduction limits and they don't have the filing requirement. You have had until the end of November 21st to go onto the IRS's website and utilize their tool, as well as provide them direct deposit information so they could make direct deposits for these accounts. Something interesting about this economic improvement payment is that there are no repayment provisions. So if your circumstances change between 18 and 19, or 19 and 20, depending on what year they used to make your determination for how much you were going to get, you do not have to pay that money back if you got paid more than you should have. You should have received a notice 1444, and those letters were issued within 15 days of the payment. And you really need to keep those for the 2020 tax returns, especially if you're in the phase out thresholds, which I'll get into here in just a second, because that will impact what your 2020 return will actually look like. And this economic improvement payment is not includable in your 2020 income. So a lot of people think, oh, it's a tax refund, it's includable in your income. This particular payment is not. So what the payments were based on every individual who, and I say individual taxpayer who was not a dependent of another, was eligible for $1,200. Married joint filers were eligible for the $2,400, and then each qualifying child meaning under age 17 and a dependent and living with you. In order to be eligible for this, you had to be a U.S. citizen or U.S. resident alien, not a dependent of another, a valid social security number. And then here's where the phase out thresholds kind of play in. As long as your income was under $150,000 married filing joint, $112.50 or $112.5 for head of household, or $75,000 for all other filers, generally the end of the singles, you would have received the maximum economic improvement payment, the EIP. They had a 5% phase out for those who exceeded those thresholds. So you were completely phased out if you had no qualifying children and you were married filing joint at $198,000. If you had qualifying children, you got an extra $10,000. And that was just the way the computation worked. Head of household was $136.5. Obviously, you had to have at least one child to be a head of household. So really $146.5. And then others was $99,000 with no children. There's an example here I'll let you take a look at where it shows you the computation. So if you're in that sweet spot between the 150 and the 198 and you had no qualifying children, if your income was 170, you would be eligible for $1,400 EIP. Looking forward, how does this EIP impact your 2020 return? We're sort of waiting for guidance right now. We know that it's going to be there. There's some speculation as to what line on the Form 1040 it's going to show up as, but we do know that they are going to be referring to it as a recovery rebate credit now. So if you did not receive the EIP in 2020, whether it was your income was too high in 18 and 19, so you didn't qualify, or you didn't have any dependents, or whatever your circumstances were, and you did not receive the credit you should have received, the full amount of the credit. You had a new child that was born, you adopted a child. If you lost your job in 2020 and your income's now lower in 2020 and you fall between that married joint 150 to 198 or the lower rates for the head of household and individuals, but if you're now in those thresholds or below those thresholds and you qualify for this, for what would have been the EIP in 2020, except they were basing it off your 18 and 19 numbers, you now are eligible for an additional credit, which will be applied on your 2020 return. A couple other miscellaneous provisions that came out of this CARES Act towards the end. There were a lot of people who were seeking telehealth just because of not wanting to go to the doctors. They were able to call into their doctors. If you had a high deductible health plan, generally those types of services, if there was not a deductible, they didn't charge a deductible for those types of services, it would have made the high deductible plan, it would have disqualified the high deductible plan. They came out in the CARES Act and they threw it in basically saying that, no, we're going to make this exclusion just because of the pandemic, people wanting to do things remote where you speak to your doctor over the phone as opposed to actually physically going into their office just to try to help reduce the spread. You would still be eligible to do that. They also expanded the definition of qualified medical expenses to include menstrual care products. And then one thing that kind of was interesting they threw in here, they're pushing for these student loan repayments to try to help students. And they added up to $52.50 of student loan repayments where they can be done through an employer's 127 plan, an educational assistance program, where the employee can exclude up to $52.50 of compensation or reimbursement from the employer, and it's only temporary for 2020, up to $52.50 of student loan payments. And again, similar to what I mentioned earlier, the interest portion for these types of plans, anytime you don't pay income on the amount you're receiving, you're also not going to get a deduction for the benefit of it. So that was just something that was thrown in there that was just a little extra. And then I think most people also heard plenty about this extra $600 of the federal pandemic unemployment compensation. Something to keep in mind here that a lot of people have lost sight of is that any unemployment is is includable into, I mean, it's includable in your taxable income. And a lot of people were only getting, most of the time, 10% withholding on their unemployment. Generally, that is sufficient when you're only getting $500. But when you tack on the extra $600, it's now doubled. So anybody who received unemployment, this is an area you definitely want to pay attention to, and you want to make sure that you're going to be covered. If you're working now and you need to do extra withholding, now will be the time to try to get that in place. And there's also, with this CARES Act, they also had thrown in an extra 13 weeks of federally funded unemployment. Now that's going to expire here at the end of 2020. Couple last minute things, estate and gift taxes. The lifetime exclusion is going up for 2020 currently, obviously, with the unknown as to where we stand with the elections, who our president is going to be going forward. This could change substantially, but at this point, these are the lifetime exclusion limits that we're looking at for 2020 and 2021 as of now. And the annual gift tax exclusion is $15,000 for both years. If you have concerns, you have a large estate, and you want to start giving some money away, you can do $15,000 per person. And if it's a husband and wife, you can make the option. You have the option to split gifts, and you can do $30,000. And if you're giving it to a child or grandchild, and they're married, you could do up to $30,000 per pair. So the husband and wife can give to a grandchild and their spouse to get you up to the $60,000. So $30,000 for the grandchild, and then another $30,000 for the spouse. And then health savings account contribution limits, those also are going up a little bit for 2021. They were $35,500 for 2020 for individuals, $7,100 for family. They're going up to $3,600 and $7,200. There is still that catch-up contribution, which has not changed. And I believe that takes me to the end. I'm going to go ahead, turn it back over to Rich so he can introduce our next speaker. Thanks, and have a great day.